So let's talk money. Today's topic is ETFs. So first of all, what is an ETF? An ETF is an exchange traded fund. So it is regulated to state a goal, invest to follow that goal, and then they will disclose their results and fees to you. All this information, by the way, is free to find online. So they will state a goal such as we will follow the S&P 500 index, they will invest in it, and they will sell shares in their pool of investments. So let's say they let's say they have $100 million. They'll invest that $100 million to mimic the S&P 500, and they will sell shares that represent a portion of that $100 million investment. Now over time, as that $100 million grows in value, the value of that little share will grow in value. Let's say, for instance, you buy $100, just to make a simple example. You'll invest $100 in the S&P 500 index, right? And you sell 100 shares, so each one costs $1. But in 10 years, maybe they're worth $2 or $3, depending on the growth of that original $100. Now, you can even look up the total asset value or the net asset value online for all of these, as well as the money that they'll charge you each year for a management fee. So now that we know what ETFs are, how do we look at them? So I'm going to work through 3 examples here of comparable ETFs that are trying to follow the S&P 500 index. That'll give you an idea of how to compare ETFs. And I'm going to put links below so you can look at the exact same information I'm looking at. So the first one I want to mention, first of all, I should mention what they have in common. So first of all, when you're looking at an ETF, does it track what it's meant to track? Okay? So they're all meant to track the S&P 500, and all 3 of these perfectly track the S&P 500. Okay? So that question I'm just going to put aside. They all perfectly follow it. Second, are they diversified? So you can run into a case where an ETF might follow an index, but might still have 1 or 2 big holdings that make you feel like you're less diversified than you could be. Now in this case, all 3 of these hold over 500 stocks. I believe it was 502, 506, 508 were the 3 numbers of holdings. And I didn't even bother to research the exact differences between them because their major holdings are the same and they're all very diversified. So again, they all track what they're meant to track and they're all diversified. So that leads to the third question, what does it cost you? So any ETF or any fund, they will charge you a fee because people have to do research to decide what stocks they're going to hold. They have to execute trades. They have to disclose information online. There are expenses that go along with providing an ETF or maintaining an ETF. This is the management expense fee. So here there is, I'll just start with the highest. It's SPY, which is actually the first ever ETF to trade, which is kind of cool. It charges 0.09%. So that's almost a 1/10 of a percentage point per year, which if you look at comparable mutual funds or whatever, this is an extremely low fee. Now the other 2 are even lower. So second place is IVV. Again, don't worry about memorizing the tickers. These all just follow the S&P 500. There's links below. Just don't worry about memorizing tickers. But IVV charges 0.07% management expense fee. Right? So this again is a little less, still less than a 1/10 of a percentage point. So it's an extremely low cost fund as well. The third one with the lowest is 0.05%. The ticker's VOO, again links below. It's 0.05%, so 1/20th of a percentage point. So in a year where the S&P 500 might go up 10, 15%, you're not going to miss 1/20th of a percentage point. And that's why you should go with these low-cost diversified funds when you can. So when I compare these 3 options, if I were to give you a recommendation, I would say there's no clear loser. None of these are horrible. I mean, SPY has the highest fee, but they all track the same thing. They're all diversified. But SPY has the highest fee, but it's not so high that it's going to ruin your returns over time. But there's no reason not to go with VOO, the one with the lowest fee in this case. So over time, I would recommend building a position in VOO. So remember, when looking at ETFs, you want to do your research and find comparable funds or different options for what you're trying to do. You want to ask yourself, do they track what they're meant to track? Are they diversified? And how expensive are they? What do they cost you? You want to take all these factors into account when you're making your decision. And maybe you have trouble balancing it. Maybe invest in a couple different ETFs that do similar things. So as always, using ETFs to hold that broad market portfolio over time will enhance your returns and help you reach your goals sooner. Thanks.